December 9, 2008. Bernie Madoff calls his sons into his apartment on East 64th Street in Manhattan and says, word for word, his wealth management business is one big lie, basically a giant Ponzi scheme. Investors had demanded $1.5 billion in redemptions. Madoff had less than $300 million left in the bank. The next morning, his sons called the FBI, not the SEC, not a regulator, the FBI, because the regulator had already been told 6 times and done nothing. The fraud had run for nearly 2 decades. The claimed assets under management, $64 billion. Direct investor losses confirmed, $18 billion. The SEC had received its first detailed warning 8 years earlier. This is not a story about one man's genius. It's a story about a machine that works so well that 16 years after Madoff's arrest, operators in Pennsylvania, Texas, and Antigua are still running the same play, and still winning. To understand why the machine is so durable, you have to understand how legitimate Madoff looked, not just to ordinary investors, to the most sophisticated people in finance. Bernie Madoff served as chairman of NASDAQ twice. He was not a fringe operator. He was the establishment. He helped write the rules that governed electronic trading in the United States. His firm, Bernard L. Madoff Investment Securities, sat on the 18th and 19th floors of 885 3rd Avenue, the Lipstick Building in Midtown Manhattan. Clean, modern, impressive. The kind of address that told investors they'd already arrived. The 17th floor was different. It was locked. Even most Madoff employees couldn't get in. That was where the Ponzi actually lived, run by a skeleton crew, on a single ancient AS400 computer, printing fake trade confirmations. But upstairs, the legitimate market-making operation was real and profitable. That was the genius of the architecture. The real business was the alibi for the fake one. By his own admission in his March 2009 guilty plea, Madoff stopped conducting legitimate securities trading for his advisory clients in the early 1990s. The returns clients saw on their statements were invented, every single one. His pitch was not get rich quick. It was the opposite. Madoff promised steady, modest, consistent returns, typically 10 to 12% annually, through a strategy he called split strike conversion. Boring, plausible, irresistible. Exclusivity did the rest of the marketing. You couldn't just call Madoff and invest. You had to be referred. Country clubs, Jewish charities, Palm Beach dinner parties. If you got in, you were supposed to feel lucky. He cultivated regulators directly, SEC rulemaking staff, former agency officials. His niece, Shana Madoff, married Eric Swanson, a former SEC official who had worked on an examination of Madoff's firm. The lines between regulator and regulated had dissolved long before anyone noticed. By the mid-2000s, Madoff managed an estimated $17 billion in client assets. Banks, hedge funds, charities, and sovereign wealth vehicles around the world had exposure. This was the peak, maximum credibility, maximum damage. The first warning came in 1999. Harry Markopolos, a Boston-based derivatives analyst, was asked by his boss to reverse engineer Madoff's strategy so the firm could compete. Within hours, he knew something was wrong. The math didn't work. Madoff's reported returns were not just good, they were statistically impossible. They didn't correlate with market movements. No legitimate strategy produces smooth, consistent gains, regardless of whether markets are up, down, or sideways. That's the fingerprint of invented numbers. In May 2000, Markopolos submitted a written fraud report to the SEC's Boston regional office. He was specific, mathematical, documented. That is warning number 1. The SEC did nothing. He resubmitted in 2001. Warning number 2, still nothing. Madoff was, at this point, managing billions in client funds and growing. In November 2005, Markopolos escalated. He delivered a 21-page report titled simply, "The World's Largest Hedge Fund is a Fraud." He handed it directly to the SEC's New York office, to branch chief Megan Chung. The report named Madoff by name. It outlined at least 29 red flags. It laid out two scenarios. Either Madoff was front-running his broker-dealer clients, or the entire advisory business was a Ponzi scheme. Those were the only two options the math allowed. That is warning number 3. Markopoulos also warned the SEC that if they investigated, Madoff might flee the country. He specifically asked them to move quickly. They opened a cursory inquiry. Then they closed it. Let's pull the timeline. By November 2007, Megan Chung approved an internal SEC memo closing the Madoff investigation without bringing any claim. Madoff had now been flagged to the agency for 7 years. 0 charges, 0 subpoenas. Not a single trading record was ever pulled from a third-party exchange to verify what Madoff claimed to be doing. Markopoulos resubmitted again in 2007, warning number 4. He resubmitted again in 2008, warning number 5. 5 separate written submissions, 9 years. The SEC's response each time amounted to the same thing: silence. Markopoulos would later tell Congress, "I gift-wrapped and delivered the largest Ponzi scheme in history to them, and somehow they couldn't be bothered to conduct a thorough and proper investigation because they were too busy on matters of higher priority." His prepared 65-page congressional testimony went further. SEC securities lawyers, if only through their investigative ineptitude and financial illiteracy, colluded to maintain large frauds such as the one to which Madoff later confessed. While the SEC filed nothing, Madoff's scheme kept compounding. Every dollar of new money that came in was used to pay the redemptions of investors who wanted out. A treadmill that could only stop one way. Now here is the detail that still demands an explanation. The SEC's Boston, New York, and Washington offices all had contact with information about Madoff at various points. That information was never shared between offices. They were each working, or more precisely, not working, in complete isolation. The SEC's own Inspector General would document all of this in forensic detail. But before we get to that report, there is a parallel story running simultaneously, one the SEC was also ignoring, that proves Madoff wasn't an anomaly, he was a pattern. Robert Allen Stanford. While Markopoulos was submitting his third Madoff warning to the SEC, Stanford was running the second largest Ponzi scheme in American history from a Caribbean island. Stanford's vehicle was Stanford International Bank, based in Antigua. He sold certificates of deposit promising returns far above market rates, backed, he claimed, by a secret, diversified investment portfolio. The CDs were the product, Antigua was the jurisdiction, and the SEC's Fort Worth office was supposed to be watching. In 1997, 8 years before Stanford was charged, the SEC's Fort Worth Examination Group concluded, internally, that Stanford's CDs were most likely a Ponzi scheme. Those are their words, not an analyst's suspicion, an official internal SEC conclusion. They took no action. That is the third warning ignored across 2 separate frauds in 2 separate offices in 2 separate decades, and the SEC's Fort Worth office would revisit Stanford and reach the same conclusion again in 1998, 2002, and 2004. Each time, no action. By the time Stanford was finally charged in February 2009, on the same week Markopoulos was testifying about Madoff before Congress, Stanford had collected roughly $8 billion from approximately 280,000 investors globally, 12 years after the SEC first knew. The structural overlap between Madoff and Stanford is not coincidence. It is a template. Community credibility, Madoff's Jewish philanthropic network, Stanford's Houston and Caribbean elite, combined with a plausible investment wrapper, combined with a regulator that cannot or will not act. Now fast forward to 2017, Lancaster County, Pennsylvania. Amish farmland, Mennonite communities, a region built on generations of trust between neighbors. A man named Darrell Heller is about to read from the same playbook. Heller's pitch was ATM machines. He told investors their money would be used to buy and operate cash ATMs. tangible, physical, easy to understand. He promised regular monthly income, the kind of steady, predictable return that appeals to communities that distrust Wall Street. He operated through two entities, Prestige Investment Group LLC and Paramount Management Group LLC, both registered in Lancaster County. Between January 2017 and June 2024, he raised $770 million from approximately 2,700 investors. Here's the number that defines what Heller was actually doing. His ATM network generated $28.6 million in net operating income across the entire period. He distributed $397 million to investors. That is a 14-to-1 shortfall. Every distribution above $28.6 million was paid with someone else's money. The SEC's complaint against Heller states he misappropriated $185 million for personal use. The agency's associate director, Scott Thompson, put it plainly. Heller allegedly exploited his connections to his community and deceived retail investors into thinking the ATM investments were safe and reliable. That phrase, exploited his connections to his community, has a name in the fraud literature: Affinity fraud. It is the single most efficient delivery mechanism for a Ponzi scheme, and it has been the mechanism in case after case after case. Now add the fourth case. January 2024, Texas. The SEC charged Gopala Krishnan, the principal of Nanban Ventures LLC, with running a $130 million Ponzi scheme specifically targeting the Indian American community, promising 18% annual returns under a venture capital cover story. 18% annual returns, guaranteed, through a venture capital fund. Let's trace what that means. A legitimate VC fund takes equity stakes, holds for years, has a small number of large wins and many losses, and cannot promise any return at all, let alone a fixed 18%. The promise itself is the evidence. Krishnan, Heller, Stanford, Madoff. Across 4 decades, 4 jurisdictions, 4 communities, the structure is identical. A trusted insider, an investment wrapper the target community finds plausible, returns that are too consistent, and a regulator that keeps arriving years too late. The email that should have broken the Madoff case open was still sitting unread in 2007. But one document was going to change the official record permanently, and the email that triggered it came from the SEC's own Inspector General. December 11, 2008. Bernie Madoff is arrested in New York City, charged with 11 felony counts: securities fraud, wire fraud, investment advisor fraud, money laundering, perjury, and more. He is 70 years old. He has been running the scheme for at least 15 years. The arrest triggers immediate global panic. Banks in Europe, charities in the United States, hedge funds in the Cayman Islands, all of them have exposure. Some are wiped out entirely. On February 4, 2009, Markopoulos sits down in front of the House Financial Services Subcommittee in Washington. The hearing room is packed. He has waited 9 years for this moment. He does not appear relieved. He appears angry. If a $50 billion Ponzi scheme doesn't make the SEC's priority list, he tells the committee, then I want to know who sets their priorities. The chamber goes quiet. He also discloses on that same day that he is handing regulators a separate case, a $1 billion mini Madoff he had already identified. The implication is brutal. He has found another one while the first one was still being prosecuted. On June 29, 2009, Judge Denny Chin sentences Madoff in federal court in New York. The sentence, 150 years in prison, the statutory maximum. Chin calls it a fraud of staggering dimension. Then comes the document that changes everything, or should have. On August 31, 2009, SEC Inspector General H. David Kotz releases Report OIG 509, nearly 500 pages, the official autopsy. The report's central finding, in Kotz's own words, a thorough and competent investigation or examination was never performed. 6 credible warnings, 5 contacts between the SEC and Madoff's firm. Not one time did an examiner pull independent third-party trade records, not once. That pause is not rhetorical. It took 9 years of documented warnings, a global financial crisis, and a fraudster confessing to his own sons before the SEC's failure was officially confirmed on paper. The regulator did not catch Madoff. Madoff caught himself. Senate Banking Committee Chairman Chris Dodd testified, Bernard Madoff stole $50 billion. He stole the retirement savings and the economic security of families across the country. And the Securities and Exchange Commission didn't stop him. February 17, 2009, the SEC and FBI raid Stanford Financial Group's Houston headquarters, 10 days after Markopoulos's congressional testimony. Stanford is charged with an $8 billion fraud. His arrest photo tells you nothing about the 12 years the SEC knew. In 2012, a Houston jury deliberated for 3 hours before convicting Stanford on 13 of 14 counts. Prosecutors called him a ruthless predator who lived a life steeped in deceit. Judge David Hittner sentenced him to 110 years in prison. April 2021. Bernie Madoff dies in federal prison at age 82, still serving his 150-year sentence. He never expressed remorse in terms his victims found credible. The trustee liquidating his estate had, by that point, recovered roughly $14 billion, but $18 billion in direct losses was never fully returned. September 3, 2025, the SEC files its civil complaint against Darrell F. Heller in the Eastern District of Pennsylvania, $770 million raised, $400 million in investor losses, $185 million allegedly taken personally. The community, Amish and Mennonite families in his own county. The playbook, Madoff's, verbatim. When we trace the money in the SEC's Heller complaint, the mechanism is textbook. Investor funds flow into Paramount Management. A fraction buys actual ATMs. The remainder funds Heller's personal expenses, private aircraft, real estate, and pays earlier investors their returns. Classic circular flow. The SEC's Enforcement Division filed the case on September 3, 2025. As of filming, no criminal charges have been announced. Heller has not been convicted. The civil complaint represents allegations, the agency's version of events that will be tested in court. So who is running the next one right now? That is not a rhetorical question. In 2023, investigators uncovered 66 Ponzi schemes in the United States, a 7-year high, nearly double the number from 2021. In the first 8 months of 2024 alone, 73 new schemes. From 2008 through 2023, researchers documented 1,108 Ponzi schemes in the United States. The average scheme size, over $70 million. That is not a handful of rogue operators, that is an industry. The SEC ordered $8.2 billion in financial remedies in fiscal year 2024, the highest total in the agency's history. At the same time, its total enforcement actions fell 26% from the prior year. More money ordered, fewer cases filed. The ratio does not inspire confidence. The machine keeps running because the structural conditions that made Madoff possible have not been changed. Regulators remain under-resourced for complex financial fraud. Affinity communities remain high trust and therefore high vulnerability. And the one systemic reform that would make the biggest difference, mandatory whistleblower response timelines, still does not exist. Markopoulos filed 5 submissions in 9 years. There is no law requiring the SEC to respond to a fraud submission within 30 days, or 90 days, or ever. A submission can simply sit, as his did, until the fraud collapses on its own. The next Madoff is not some future hypothetical. The 73 schemes reported in the first 8 months of 2024 represent cases that have already been discovered, the ones that collapsed fast enough to be caught. The ones that are still running look, right now, exactly like Madoff looked in 2003, professional, exclusive, consistent, and trusted. The 3 questions worth asking about any investment you encounter are the same 3 Markopoulos asked in 1999. Do the returns correlate with market conditions? Can the strategy be independently verified? And does the operator become evasive when you request a third-party audit? 3 simple questions that 9 years of SEC examinations never managed to ask Madoff. 6 warnings, 16 years, 0 investigations, and right now in 2024 alone, 73 new Ponzi schemes were reported in the first 8 months of the year. The machine Madoff built was never dismantled. It was just handed to someone cheaper. So here's the question I want you to answer in the comments. When a regulator receives a documented, mathematically airtight fraud warning and does nothing for 9 years, should that be a firing offense or a criminal one? Think carefully before you answer, because the SEC's current answer is neither. Subscribe if you think that's wrong.